The Intelligent Investor, Episode 19, Chapter 19, Shareholders and Management. When people buy stocks, most think they're simply buying a ticker symbol, a number on a screen, something that goes up and down. But Benjamin Graham believes something very different. He believes shareholders are owners, real owners of real businesses. And if you truly understand that idea, it changes the way you invest completely. Because once you think like an owner, you stop reacting emotionally to daily market noise. Instead, you start asking deeper questions. Who is running this company? Are they responsible? Are they protecting shareholders? Are they making intelligent long-term decisions? And honestly, this chapter feels incredibly important today. Because modern investing culture often treats stocks like entertainment. But Graham reminds investors, behind every stock, there are real human decisions affecting real businesses, and leadership matters enormously. Part 1. Why Management Matters. Benjamin Graham believes strong management plays a major role in long-term investment success. Why? Because even strong businesses can become damaged through poor leadership decisions. Management controls strategy, spending, debt, expansion, acquisitions, and company culture. And emotionally, leadership behavior often affects how companies respond during uncertainty. Strong leadership usually demonstrates discipline, rational decision-making, long-term thinking, and financial responsibility. Weak leadership often becomes emotional, chasing trends, overexpanding, taking excessive risks, or prioritizing short-term appearances. Again, emotion affects business decisions too. That's why Graham believed intelligent investors should evaluate management quality carefully, not emotionally, not based on charisma, but based on behavior, discipline, and long-term results. And honestly, this mindset is rare, because many investors become emotionally distracted by hype, branding, confidence, and exciting promises, while ignoring deeper business reality. Part 2. Shareholders should think like owners. One of the biggest lessons in this chapter is this. Shareholders are not gamblers, they are owners. That distinction changes investing psychologically. Imagine owning part of a private business. Would you ignore management decisions, financial discipline, and long-term strategy completely? Probably not. You would care deeply about how the business operates. Benjamin Graham wanted investors to develop the same mindset with public companies. Because emotionally, many investors disconnect stocks from actual businesses. They become obsessed with short-term prices, headlines, and market reactions. But Graham reminds readers, a stock represents ownership in a real company, and owners should care about competence, integrity, financial responsibility, and long-term decision-making. Again, this mindset reduces emotional investing behavior because owners think differently from speculators. Speculators focus on price movement. Owners focus on business quality. Part 3. The danger of short-term management thinking. Benjamin Graham also warns about management teams becoming too focused on short-term appearances. Why? Because public markets create pressure. Companies constantly feel pressure to increase earnings quickly, satisfy investors emotionally, and maintain excitement around their stock price. And sometimes that pressure creates dangerous decisions. Management may take excessive risks, prioritize image over stability, manipulate expectations, or sacrifice long-term health for short-term performance. Again, emotion influences behavior everywhere, not only investors. Corporate leaders experience ego, pressure, fear, and overconfidence too. That's why Graham believed intelligent investors should observe how management behaves during difficult periods. Because adversity reveals leadership quality more clearly than success does. Anyone can appear brilliant during easy conditions, but uncertainty exposes discipline, preparation, and emotional maturity. Part 4. Why Ego Becomes Dangerous in Business. Honestly, this chapter quietly explores how ego affects corporate behavior, and ego can become extremely expensive financially. When leadership becomes emotionally attached to expansion, reputation, growth, or appearing successful, they may ignore rational limitations. Benjamin Graham repeatedly warns against emotional overconfidence, because overconfidence often creates excessive debt, reckless acquisitions, unrealistic growth expectations, and financial instability. Again, successful periods often create emotional blindness. Companies begin believing we cannot fail, growth will continue forever, risk no longer matters. But history repeatedly proves otherwise. That's why Graham appreciated disciplined, humble management, leaders willing to think carefully, protect stability, and prioritize long-term survival over emotional excitement. Honestly, that mindset applies beyond investing too. Ego often destroys discipline in many areas of life. Part 5: The Intelligent Investor Values Character. This chapter ultimately teaches something deeper than finance. Character matters. Benjamin Graham believed intelligent investors should value integrity, discipline, rationality, and long-term thinking, both in themselves and in company leadership. Because markets eventually expose dishonesty, recklessness, and emotional excess. Again, emotion may temporarily create excitement, but long-term success depends on stability, discipline, and sound decision-making. And honestly, that lesson feels increasingly important today, because modern markets often reward confidence, hype, and short-term attention, while Graham's philosophy remains grounded in responsibility, patience, and rational behavior. Final outro. So what's the deeper lesson of chapter 19? Investing is not only about numbers, it's about people. Benjamin Graham believed intelligent investors should think like owners, carefully evaluating leadership, discipline, integrity, and long-term business behavior. Because strong management can strengthen businesses, while emotional or reckless leadership can quietly destroy them over time. And honestly, that understanding separates thoughtful investing from emotional speculation. Next chapter, we'll reach the heart of the intelligent investor, the margin of safety, the principle Benjamin Graham considered the foundation of intelligent investing, and the idea that has protected investors from financial disaster for generations. See you in the next chapter.